welcome back to the trading desk. Dave, we were talking a little bit before the break about how possible change in character has happened in the markets, and there's usually a moment where traders kind of can feel that or see that, and we kind of touched on that in the charts. And SDS is one of those things that if you believe the S&P may have hit an interim high, is a way for you to bet on the downfall of the S&P 500. And the way that I like to look at charts like this, and I think you would agree with this, is think about a ball that is bouncing, the higher, and it gets smaller as it goes, and then it just rolls out.
Yep.
And this chart is doing that.
It's exactly, yeah.
I mean,
and I think for clients, or not for clients, but for viewers at home, if they are of the opinion, or even if they're not of the opinion, if you want to use this as a hedge, let's say you're invested fully, you might want to have a piece of this on as a way to hedge in case stocks do in fact go down, because this ETF will rally. And since it is an ETF, anybody can buy it through a discount broker. You can buy it through your full service broker if you happen to use one. I personally probably going to look to put this trade on in my personal account, because I think it's trading at around $35 right now. I think if it goes back below $32.50, all bets are off.
We're going to go higher again, exactly.
And I think that we could probably go up to 45 or 50 on this. So the risk relative to the reward, I think, is quite good.
And I agree. I mean, if you look at where the S&P came from, 666 all the way up to 1150, and that's 500 points. And again, if you go by, again, the bouncing ball rule, half of that move would be 250 points, which gets you down somewhere to that 900. I'm not saying we're going to go to 900 tomorrow, but it's going to be a tough year. I think 2010, you and I have said, is probably going to be, slapped into a range of 900 to 1250. And we're sitting here at 1100 now, basically, after a 50-point sell-off. So we've just begun to sell off, and we haven't seen that size of sell-off in a long time.
I agree.
So as we said earlier, watch, there's a number of pieces of the puzzle here that are lining up. 2 days of sell-off that got us 6%. You've got housing numbers came out today, 17% below expectations. So, these first-time home buyer credits and all these things that the government are running out, they're done. They're done in March. So that's going to lead to a further struggle in the economy. There's still the job situation hasn't gotten better. You got Obama again coming out today every day with some program to, write checks to people, but I don't know how he's financing all this.
So that's a different topic altogether.
It is a whole different topic, but it continues. The market sees this and is starting to feed on this, and the market always turns a little bit earlier than people recognize.
And I think you hit upon the key thing. It feels a little different this time. The attacks from the administration on the banking sector, while I think warranted on some level, that creates a lot of uncertainty. I think good things will come out of that, actually. I think a lot of very smart people will go off and do good things.
And that's one of the things our interview talks about today with Paul Kondrowski.
But you're adding an element of uncertainty to the market that we haven't had for the last 6 months. The last 6 months have been low interest rates, relatively, modestly improving economic data. That's starting to be called into question now, and I think that's why you started to see the S&Ps come off last week.
And the honeymoon is over for Obama. Your year is over. I mean, you've been in power for a year.
We're going back to gridlock, probably.
We are. I mean, it's so interesting. Healthcare was so talked about, much like when Clinton first came in, first term, and it's fallen apart again. And it is such an area where I thought he really could have, done something positive. And it's such a big piece of the GDP. It would have been very powerful. Now, like you said, back to gridlock. It's almost as if Republicans and Democrats both want status quo and don't want anything to happen.
I think that's what the Fed wants. And we've been talking about that for a while. The Fed doesn't want to have the boat rock. So, but with regards to the banking sector, hadn't really thought about it a lot until I watched the interview this morning with Kondrowski. I really think a lot of these really smart quantitative guys, maybe they're not going to be employed by hedge funds anymore, but maybe they can go off into the private sector and engineering, science,
and I want to talk about that when we come back. So we're going to continue to talk about banks as it applies here locally and nationally. But when we come back to the trading desk, we're going to talk more about the banking sector, and then we're going to go to a break with Paul Kondrowski after that segment.